All right, I think we're ready to go. Um, Good morning, everybody. My name is Greg Homan, and I'm here to moderate today's session on emerging trends in California's E&S marketplace. I'm the Chief Underwriting Officer here at Golden Bear Insurance Company, and I do want to take a quick second to thank the All Industry Day Committee for inviting me to be today's moderator. In particular, I want to call out a special colleague of mine, Susan Atkins. Susan is one of our property team leads here. She manages one of our large earthquake books. And I'm relatively new at Golden Bear. I've been here about 6 months. And 2 months ago, she walked down and knocked on my door and said, "Hey, Greg, as the new CUO, we'd love for you to moderate a session at the upcoming All Industry Day session for CPCU." And of course, being relatively new, I scratched my head and said, that sounds like a little bit of extra work to do. But I had to self-reflect for a minute. And I am a fellow CPCU. I got my designation back in 2007, and I appropriately timed this so I would be able to go to Honolulu, Hawaii for the conferment ceremony. And I'm forever grateful for the experience that I got from CPCU and the network that I built. But as my career started to escalate and I got more and more responsibility, I found myself distancing myself from the CPCU Golden Gate chapter where I really cut my teeth. So great to be part of the Golden Bear team where there's a ton of engagement around CPCU. This organization really encourages continuous education. Every time I get on LinkedIn, I feel like there's another colleague who's completed another exam. And it's one of the really visible parts of our company where there's a lot of rewards and recognition. So one other thing I'd like to say, not many people know about Golden Bear. I think we are one of the best kept secrets, one of the most successful best kept secrets in the industry. And if somebody asked me to give a very brief elevator speech on Golden Bear, I'd say, there's 4 L's that I would use to describe us: leadership, location, longevity, and lineup. And around leadership, we are a privately held, family-run company. I think that makes us very unique. Strong track record of underwriting discipline and claims discipline. So leadership is paramount. Location, we are uniquely positioned in Northern California. Our headquarters is here in Stockton, California, which puts us right in the middle of one of the most interesting, diverse, and complex states to transact business. Longevity, we've been in business for over 40 years. And last but not least, our lineup. Not only our lineup in terms of product and services, we've got a diverse range of property, casualty, and specialty insurance products, professional lines products, but our lineup of people. We've got some of the best talent in the industry. So that's my pitch on Golden Bear. I want to talk a little bit about our session today. So we've got 3 unique sessions where we'll do individual presentations from 3 disciplines in the E&S market. Then we'll do a brief panel discussion. Then I'll invite it out to the group here for some Q&A. Now, our 3 sessions, first, we will have the Surplus Lines Association talk a little bit about some market share details and some regulatory trends. Then we'll hear from the leading wholesale broker to talk about some distribution trends. So what are our brokers seeing in terms of opportunities and challenges that are impacting how products get distributed? And then third, we're going to hear from 2 reinsurance intermediaries to talk about the availability or potential lack of availability in reinsurance opportunities that enable direct primary insurers to scale appropriately and respond to demands in the marketplace. Now, I've spent 25 years in the industry. 20 of those 25 years have been in the admitted market. The last 5 have been focused more on E&S, and that's no surprise. There's been a bit of a gold rush or a boom, if you will, in terms of the E&S marketplace. I can tell you, I think this is one of the most misunderstood or most mysterious parts of our industry. So hopefully by the end of today's session, we will be able to demystify some of that and bring a little bit more enlightenment around what's going on in E&S. So what is E&S? E&S is a part of the market that is used to insure risks that the traditional or admitted marketplace typically can't. So think about exposures that might be unique, that might be new, might be complex, that fall outside of traditional underwriting guidelines. Oftentimes there is a loss cost inflation that is outpacing an admitted market's ability to get DOI approval for new rate filings. So this is sort of a backstop, an area of last resort for some of those products to go find coverage. Unlike admitted carriers, E&S insurers have a large degree of flexibility in rate and form. It allows E&S carriers to respond much faster to emerging risks. Some of the industries that they service would be things like cat-exposed property, heavy construction, tough products, cyber liability, various types of professional liability. So in many ways, E&S is the pressure valve for the insurance industry, keeping coverage available when the admitted market starts to tighten up. Now, the surplus lines market is not new. Its origins in the US are more than 100 years old. Some could argue it even goes back more than 300 years if you want to talk about the first Lloyd's policy that was ever underwritten. Technically, Lloyd's is a not admitted surplus lines carrier in the United States, but its importance has never been greater than it is today. It's growing like crazy. 2024 saw direct premiums written in excess of 130 billion. Over the last 5 or 6 years, it's been consistent double-digit growth, with a peak in 2021 where direct premium written was up 30% over prior year. And despite some market conditions and some product lines that are showing a bit of rate moderation recently, the first half of 2025 still saw direct premiums written in 15 stamping offices up 12% over prior year. So the ongoing growth continues. So I'll close with this as my overview for surplus lines. Is it really is the part of our market that thrives on flexibility, creativity, and speed. So without further ado, I do want to introduce our panelists today. First up, we have Mr. David Kadama. David is the Chief Industry and Regulatory Officer of the Surplus Lines Association of California. In his role, David oversees the financial analysis, legal compliance, and policy and training departments, where he brings 35 years of experience and deep background in surplus lines, actuarial science, policy analysis, and industry and regulatory relations. His efforts strengthen the advisory services of the SLA on matters that impact surplus lines industry and the California insurance marketplace. David's held previous roles at the APCIA, formerly PCI, CNA, and Kemper, and he has a Bachelor's of Science degree from Penn State University, who David, I hear, has recently fired their head football coach and is out in the marketplace for a replacement for James Franklin. So, David, did I miss anything about your bio there in the intro? And then if you can answer two really easy ice-breaking questions. How did you end up in the insurance industry? And then is there any personal risk that you've taken relatively recently that paid dividends for you?
I think the only thing I didn't have in that bio was that I'm proud that the Surplus Line Association of California is a founding member of a relatively new industry organization called Sierra. It's the California Insurance Emergency Response Association, which I currently serve as president. And that is an association that is working towards better preparing and enabling our industry in the event of a large scale of natural disaster or even man-made disaster. We saw it in the LA fires when we're coming in, when the industry is coming in to respond. There's a lot of coordination, a lot of information that we get overloaded with. Sometimes it's misinformation, disinformation, especially in this technologically advanced age. There is a need for better coordination, communication, and cooperation, not only amongst the private industry, but with the government agencies, the emergency management services. And so this is a mission and purpose of Sierra, is to engage proactively with all those stakeholder groups to say when the event happens, how can we make sure that we have the most efficient response publicly as well as privately. So I'm very proud of that involvement. So that's just one other thing that I have on my bio. And then how I got into this industry. I was a actuarial science student. So I was recruited right out of the Pennsylvania State University from CNA Insurance, pulled me out, moved myself to Chicago and started my career in the insurance industry. I deliberately got in insurance and have had a great career and lots of great experience in the last being 5 years plus at the SLA of California. And then from a personal risk, somewhat related to what I do now is, I live in one of the largest HOA communities in California. And we've, like many other HOAs, have had struggled with getting property insurance. And so I volunteered my time to help our HOA to figure out how do we be able to get more access to insurance, which was to really make ourselves more insurable. So got involved in a lot of initiatives um, to make ourselves a FireWise certified community. Dealt with worked with the Cal Fire and Contra Costa Fire Protection District to figure out how do we create more fire breaks, follow it was the Zone Zero protocols around our home so that we could attract more insurers to provide us coverage in the state. So that's one thing I'm proud of being involved in, and we've been very effective in doing so.
Thanks, David. I find there's nothing more encouraging and inspiring and motivating to address some of the challenges that we face as an industry is when they hit you personally. So, as a California local myself, I have the same challenges with my homeowners insurance.
Yeah.
So, thanks, David. So, next up, I do want to introduce Pam Quillisi. Pam serves as the president of Ryan Specialty Transportation Underwriting Managers, which is a division of Ryan Specialty. She joined Krause and Associates in 1996, ultimately holding the position of Chief Operating Officer. Following the Ryan Specialty acquisition in 2021, Pam transitioned to her current role as the President of Transportation Underwriting Managers. She continues to drive impactful solutions throughout her group and collaborates with a number of carriers and reinsurers. Pam's been actively involved and has held many positions with the California Surplus Lines Association, making her the perfect panelist on today's panel. And she is currently on the board of directors and the chair of the Next Generation Committee. Her passion is to lead she's the co-founder of another group called Women's in Wholesale, which I am curious, Pam, to hear a little bit more about. So without further ado, did I miss anything in your bio that you want to highlight? And similar questions as David, how'd you end up in our industry, and what was one personal risk you took that paid dividends for you?
And very happy to be here today and speaking on this topic. I've obviously been in the E&S world for a long number of years, so I have lots of opinions on that. But how I got into insurance was not intentional like David. It was through my mother-in-law had one of her college friends that owned a retail shop. And back in the 90s, I literally started in the file room. And that's back when we had paper, lots of it. And then just blossomed from there, got into the E&S world in the late 90s and have had a great career in both property, casualty, and now I've been really moving strong in the transportation world for the last decade or so. And a question on taking a risk. Well, if you were to ask my family, they would say that I take too many risks because I like to travel and I like to go to foreign countries a lot, and they just hold their breath till I get back. But one that I thought was a personal risk was my daughter got married last week, and it was her second marriage. And so I decided, I knew I was going to be speaking, but I decided not to really prepare for that speech. It would just come to me. And getting to the venue, it was a destination wedding. I happened to have forgotten to bring the marriage certificate that was left back at a hotel. I go darting out to the parking lot looking for somebody that could drive me back to the hotel to get me back in time. And there I see her ex-husband, her previous husband, her first husband. And I'm like, hey, you've got to drive me. And he goes speeding off down the road. And it was so comical as he's speeding and I grab it, I get back just in time. We never tell my daughter that this happened because she would just freaked out. So how I start my speech that day was, well, Emily, you didn't know this, but you didn't have a marriage certificate. But Eddie saved the day, your first husband saved the day and got us all here we are today. So I like to say that he's the one who got them married that day. So that was kind of a funny little risk that I took.
Well, I'm glad you got there safely and it all worked out.
Yes, it was comical to say the least.
Well, thanks, Pam. Look forward to having you back on camera in a couple minutes. And last but not least, I want to introduce our two reinsurance intermediaries. We have Danny Souza and Mark Hargraves, both with Acrisure Re. Danny is the head of office in the San Francisco office for Acrisure Re. He specializes in structuring placement and account management for reinsurance, property, casualty, and specialty lines. Since joining Acrisure Re, Danny has secured worldwide capacity for traditional reinsurance clients, including regional, national, and global companies, as well as many MGA clients and programs that specialize in various types of insurance. My favorite part of Danny's bio is he was a student athlete at San Francisco State University, where he played collegiate baseball. So, Danny, we'll start with you. Anything I missed in the bio that you want to highlight, and then a risk that you've taken that paid dividends for you?
Yeah, no, Greg, thank you for the introduction. Nothing, I think, to point out from the bio, but to jump on some of the questions that you asked. Much like many people in the insurance and specifically the reinsurance industry, I fell into this through a connection. So after college baseball, the realization that maybe the big leagues were not the next step here. I had thought I was going to go the finance route. That was the major I had studied in college, and thought I could potentially link that to something in sports until someone in the industry asked, "What are your thoughts on reinsurance?" And my dad was in insurance for 40 years. Did not think I was going to go that route. My first question was, "What is reinsurance?" And next thing I know, I moved across the country from California to New York to join Beach, which was then purchased by Acrisure and now rebranded to Acrisure Re. So fell into it through a connection, and then haven't left since. Same company for 10 years, and now back in California to head up our West Coast expansion. So very excited to do that. In terms of personal risk, I was going to talk about the move after 10 years in New York, thinking the next stop for me was potentially running that office over some time. I was excited to move back to California to start this up, but I'll take it away from insurance for a second and maybe go a different direction following Pam's story. I recently was in Kentucky and knew I was going to be on a Bourbon Trail whiskey tasting, but still decided I could make a 6 a.m. flight the next day. I will say I did make that flight. It was not the easiest thing in the world, but risk paid off because there were weather delays shortly after, and several friends ended up in Kentucky in a hotel for a lot longer than I did. And so made a warm welcome back to California. So nice to meet you guys, and look forward to our session today.
Glad you made it back safely, Danny, and thanks for your time on the call today. Last but not least, we have Mr. Mark Hargraves. I think Mark made it on the call today. Mark is also a senior vice president at Acrisure Re. He sits in the San Francisco office, joined the firm in 2023 after 8 years as a broker with both Aon and BMS Re. Similar to Danny, he's got expertise in property, casualty, and specialty reinsurance placements. He holds an ARM designation and a Bachelor's of Business Administration from Bishop's University, which I believe is up in Canada. So, Mark, you on the call today? And similar, did we miss anything from your bio that you want to highlight and talk about a personal risk that paid dividends for you?
I think Mark is not currently in the meeting right now. As soon as he joins, I'll add him to the group.
Oh, perfect. We'll have Danny do double time for us. So
I will say, so Mark works with me. We've known each other for a very long time. He is also out here on the West Coast helping lead our expansion out west. Mark is originally from Canada and was in Aon Canada for about 7 years before moving to California, where he ended up joining Aon, and his now wife is also from California. So that allowed him to move out this way, and I'm very happy to have him on our team here. Mark is, I guess, his personal risk, which I can speak to now, is we were at a conference at the beginning of this week, and his 7 a.m. flight clearly did not make it in time to join the beginning of this. But he did tell me that he has landed, so he will be here for the session when we talk reinsurance later today.
Thanks, Danny. All right, David, I think this is where we're going to turn it over to our three individual sections. So we're going to start with the Surplus Lines Association, where David's going to talk about some of the tracking, the filing, some of the regulatory trends that we're seeing through the SLA. So, David, without further ado.
Yes, thank you, Greg, and thank you and Susan for this invite to speak with your fellow CPCU members and this opportunity to represent the Surplus Line Association of California on this distinguished panel. Uh, to start, I thought I would level set for those that may not be familiar with the SLA. The Surplus Line Association of California plays two major roles for the specialty market of surplus lines insurance. The first role is that we are a private nonprofit member association that serves all California licensed resident and non-resident surplus lines brokers, including my fellow panelists here and SLA board member Pam Quillisi. The SLA provides general assistance, guidance, education, and networking to these brokers transacting in our Golden State. Through our learning center that anyone can access via our website, the SLA offers California-approved continuing education courses, both as live webinars and through an increasing catalog of on-demand video courses. This SLA's second role is to serve as the appointed advisory organization to the California Department of Insurance on all matters related to surplus lines. We are not, to be clear, we are not a part of the department, but we work closely with the CDI to help ensure broker compliance with all pertinent laws and regulations, and to monitor financial health and the operation of insurers writing surplus lines insurance in the state. Now, the unifying theme between both of these roles is that we are here to foster a healthy, fair, and competitive surplus lines marketplace in California. So if you have any questions about the SLA or the California surplus lines market, I would encourage you, please do not hesitate to contact me directly or the SLA. It is our core commitment to be that valued resource to the industry. So with that in mind, I was asked to offer some insights into these state filing trends with a breakdown by line of coverage and industry sector, and then to comment on some factors impacting the recent growth in market outlook. One of our delegated duties, delegated responsibilities from the CDI is for the SLA to review all transactions of surplus lines insurance filed and registered in compliance with the applicable statutory requirements. For 2025, the SLA is projected to register almost 1.6 million transactions, accounting for nearly 24 billion in premium on insurance risks for which coverage was found to be unavailable in the standard admitted market. And Greg did a great job in saying why some of these insurance risks fall into the surplus lines market. But this is again the insurance market's safety valve for those hard to place risks that has been on a consistent growth trend line for well over 10 years, and many years being double digit, if not over 20% growth. Just like in 2025. I'm going to share my screen here. I wanted to show some stats. Greg, if you could just confirm that everyone that you can see them.
We got it.
All
Yep.
right, excellent. So the figures here do represent this a 26% growth in transactions filed and a 16% growth year over year in premium for California. This graph gives you a little more insights into what lines of coverages are growing at different points of time over the last 10 years. So you'll take note that 86% of the premium, 88% of the transactions come from three major lines of coverage. That is property, general liability, and professional liability, which we also include cyber insurance with. 10 years prior, it was for those three lines of coverage, it was 84% of premium and 86% of transactions. So not much of a difference from 10 years ago, but we'll take note of the property line where it was at 29, had a 29% share of the premium and transactions, and now is at 42 and 45% respectively. So can anyone guess what is driving property? So you can imagine it is homeowners insurance. So as Greg alluded to earlier, there's major admitted insurer groups that have withdrawn from the California market and are just remaining on the sidelines waiting for regulatory reforms in that admitted market segment. And so the surplus lines market continues to play that safety valve role, and we continue to see that growth. So moving on.
David, do you know if
Yes.
we looked at other states' stamping results, would they show a similar trend, or is this uniquely California?
In the homeowners insurance, or
I think, yeah,
the
homeowners
growth?
might be the obvious example, but the other
Yeah.
lines, do you think it's a similar trend?
No, I think the homeowners market is you see some significant growth in other states driven by catastrophe risk, but we have the added added factor of the regulatory process has severely restricted the admitted carrier's ability to keep up with the risk, with the loss cost trends, with social inflations and the like. So that has added additional motivation to move business into the non-admitted surplus lines marketplace. So we're definitely on the top end of that growth and for that line of business. And then just generally, you see most states are showing growth even in 2025 in terms of premium across the country. Okay. Moving on this next graphic, this kind of gives you a breakdown of what industry sectors are purchasing surplus lines insurance. And so these industry sector definitions come from the North American Industry Classification System, or NAICS. Some people may be familiar with the SIC codes. We're using a more updated classification system called NAICS, so as we define those sectors. And here I would just highlight that 47% of the commercial premium some recent 12 months is in the California surplus lines market is construction, transportation and warehousing, and real estate, rental, and leasing sectors. So for additional context, constructions include those home builders, construction companies and contractors, and real estate developers. Transportation in the warehousing sector includes transportation services, obviously, but it also includes those technology platforms for sharing economy services like ride sharing, food and meal and grocery delivery services. And the real estate rental leasing sector includes the REITs, the real estate investment trust, real estate investment and property management firms. So you'll note that 5 years prior, these three sectors represented just under 40% of the market in terms of premium, and 36% of the California premiums, and this is commercial premiums, 10 years ago. So any questions about that? I'll leave that up for a few more seconds, but before I move on, I do invite you to drop any questions that you may have about these exhibits into the chat, and I will do my best to address them. Again, they just are intended to offer a snapshot of our market and how it kind of has evolved over the years, and specifically the last 10 years. But I do want to highlight that more insights of our market and how it is continuing to evolve are available on our SLA website under industry reports. And so I'm going to put in the chat, get back to the chat, the URL for that. Let's see. Okay, Greg, did that go through?
We got it.
Okay. So I add the URL directly to the SLA website, to our industry reports, and then also I added the link to our learning center, where again, anyone there's educational content on our marketplace, on our industry, specifically designed for our brokers, but they are just as I think just as valuable to anyone who is interested generally about our market space, about surplus lines insurance, and about the emerging risks that are coming into our market space for anyone of any industry professional or even students that are entering into insurance as a career. So if I have time, just a few other observations I would share about our market include the emergence of new MGAs specializing in insurance solutions for the likes of homeowners insurance, as well as earthquake and flood, especially now during this government shutdown that we're in, that's impacting the NFIP program, the National Flood Insurance Program, seeing some growth, some numerous new markets around landlord insurance. And I think that's corresponding with the rise of the likes of Airbnb and on-demand short-term house and condo rentals. And then also I'm seeing significant growth in terms of trucking insurance for owner-operators. A number of specialty MGAs are popping up there. And of course, I would be remiss if I didn't add some commentary about the homeowners insurance and the regulatory environment surrounding that and the implications for surplus lines. I do want to highlight some stats of interest. In 2022, surplus lines brokers placed homeowners coverage for nearly 47,000 homeowners in California, totaling a little more than $540 million in premium. By the end of 2024, the last full calendar year that we have, the totals were 219,000 transactions and over $1.1 billion in premiums. So that's a nearly 5 times growth in transactions and more than twice of an increase in terms of premium. Homeowners has gone from being 5.5% of all surplus lines transactions to almost 21%, and 3.5% of total premium in California to 5.7%. So that's a bit higher percentages than other states. But like I said, we have an additional factor of these regulatory reforms that are going into place, and I think the mid-market's still waiting them out to see how they get implemented. In comparison, there are well over 8 million policies accounting for $13 billion in premium still in the mid-market, according to CDI reports, and now well over 600,000 policies or $1.3 billion of premium in the FAIR plan. So those are just some comments I wanted to share with you. Again, if there's any additional questions, I'm more than happy to take those and try to address them as best as I can. And with that, I will toss it back over to you, Greg.
Well, David, I'm gonna put you on the spot with one
Sure.
final question here before we transition to Pam. So, looking at your crystal ball over the next 24 months, is there a single line of business that you think is most primed for growth in E&S? And is there another line of business that you think is most primed for contraction?
Well, I think in line with the last session in the discussion about AI is going to be a major factor that's going to, I think, hit multiple lines of coverage. So the most obvious is in the cyber, but also general liability, professional liability, D&O, property exposure, and even auto. It all depends on like how AI gets utilized in all of the respective industry sectors, whether it's health, transportation, construction, retail. If you're using AI, if you're dealing with clients, if insureds that are leveraging AI, there is an evolving level of exposure that we all, as underwriters, as brokers, as insureds ourselves, as risk buyers, need to be cognizant of because the the standards, the legal standards, the privacy standards, the regulatory standards, it's all very fluid. It's all evolving, and how that impacts the risk exposure is going to commensurately evolve as well. And so it could impact your general liability. It could be a negligence claim. It could be a data breach under, in cyber. If you're a professional giving advice like a broker and you're leveraging AI, it could hit your E&O insurance. As a director or officer of a company and you're making decisions, you could be exposing your D&O and insurance coverage and auto insurance. If it's the automakers and auto manufacturers are utilizing AI, likewise, you could see exposure there. So I think AI is something that I am personally, watching very closely on how that impacts the growth of insurance. And I see, because of the fluidness of it, I expect it to be insured largely in the surplus lines marketplace.
Thanks, David. Right on brand with some of the sessions that we had this morning on AI and insurtechs as well. So I think it's a good point to turn over to you, Pam. I think Pam's got the most interesting job on the call here. She gets the opportunity of connecting the most complex risks with the right markets. They're going to show up with consistent terms, conditions, and pricing. So Pam, I'm going to give you the floor here, but I am curious in your presentation what submission trends you might be seeing. What are the challenges that you're seeing in the distribution marketplace? And then are there any change in client expectations as things are ebbing and flowing right now? So the floor is yours.
Hey, thank you. And it's good to follow David, because a lot of his comments actually flow right into what we're seeing, obviously, in my next topic of conversation. And one of the things that we've seen just over time is, in today's E&S marketplace, we have two types of risk now. We have a transactional placement, which these are classes that are falling outside the standard market, but aren't too tough. So those are the accounts that you submit them, they get quoted, they have steady pricing throughout time, and there's not a ton of movement there. But then we also have the tougher placements, and these are tougher because of either perils or classes of business. And with these tougher placements, this is where you really need to have a true E&S specialist working on these accounts. And so you need somebody who is specializing in things such as, from a peril standpoint, we're talking a lot about property. And so you need your storm specialist, right? Or your earthquake specialist. There are kind of two different dynamics there. The more recent that we've seen over the past number of years is wildfire, and that's become more prevalent. And that's a evolving market as to what we're all learning about it, and especially here in California. We now have wildfire scores and so forth. And so there's a lot that goes into that you want somebody who is also in the forefront of that, working on those solutions for you and your clients. And with casualty products, that's more of a class item. And what we're looking at here, the tougher classes there are more of your habitational, your hospitality, and both of those are for more of your assault and battery type items. And those can also be more of a logistics play as well. So habitational might be tougher in one state than it is in another. Transportation, that's just tough everywhere. That's a product line that hasn't made money for years. And then construction, you're looking at, residential, your Florida, New York, your California, anything in wraps or projects in those areas, long tail business, and then your home healthcare items as well, where you have your sexual assault and molestation issues. And these are all items in that area where you either have sublimits on your coverages or you have no coverage. So you definitely need to have a specialist in your court on any of these tougher areas, or you might not be delivering the right product to your client. And you also have to watch for sublimits that are, or just limits in excess. If you're buying excess layers, are the excess carriers appropriately covering that as well? So there's a lot going on, and not all E&S brokers are created equally. So make sure that you are looking at them, and you are you might need more than one to help you with what your items are. And in addition to that, just the E&S community has changed. So from I work with Ryan Specialty. There are other great competitors out there, and we're all looking to build a better product, for the retail brokers and the clients. And what we're doing there, it's not just that we have the traditional markets anymore. Everybody has markets, and but you need to have more than that. So to expand on that, we will go after exclusivities within certain markets, prove ourselves as being specialists, and therefore warranting better product, better niches. Within the E&S wholesale community, we might have special sublimits or coverages within a product. So you want to be careful, and you want to know that you have, broad products. And then we also have proprietary products. So we're building our own products that kind of complement these tougher areas and tougher placements. I personally have multiple transportation and trucking and business auto products that I've created to complement our other business auto and transportation traditional market carriers. And so that just gives some added value there. There's also the alternative risk products and markets that we're accessing. So in order to, some placements need us to get out into the reinsurance market. We might have to provide some captive solutions or bring in lost corridors into a program. So there's a lot of different things that are happening in these tougher placements, especially when building limits. And other items that we're having, obviously, impact from is nuclear verdicts, claim funding, social inflation, and that hits some of these areas a little harder than others. Transportation gets hit by kind of all of them, and so that's going to continue to be a tough marketplace. Not really foreseeing that softening up anytime soon. Within that same transportation sector, we're now seeing more business auto coming into the play into E&S market. And that's also consistent with what David talked about, what we're seeing here in just California. You're also seeing some trends where carriers are offering less limit. This comes in your excess layer. So maybe they provided a 10 mil lead for you. Now they're providing a 5 mil lead, or maybe they're provided a 5 mil lead. Now they're providing a 2.5 mil lead. Well, what this is now, the downward cycle of this is it's hurting the carriers that are in the higher layers. A loss comes in, they'll pay out their 2.5 mil or their 5 mil and walk away. They're no longer defending, they're out of it. So now those higher layers are now in a position of defending the claim, which traditionally they had not been in that position. So that's going to carry through to those layers. That's going to create those layers to continue to have more the increases in loss, increases in pricing. It's just changing the whole landscape of what layer and count looks like, and the carriers that are in kind of those lead layers, lead 10, lead 15 or so. And they have to be considerate of whether or not they're going to want to be there. So you do see some carriers going up higher now because they don't want to be too low and having to take on the defense of that. Another trend that we're seeing is that we're seeing more MGA and fronting carriers come into the play. And the reason for that is there are more. Go back 7-8 years, there was like 3 of them, and now we have like 30 of them. So with more MGA carriers actually available, that means more products can filter through those carriers. And with MGAs, they're and fronting carriers, all products that you see are not created equally. And what I mean by this is the carrier on the front end is one thing. Now you have to look at, okay, who's underwriting that product and who's reinsuring that product. You want to make sure that there's solvency within the reinsurance support for that product, or that could cause some problems for you and your insured. We have seen one reinsurance capital provider exit the marketplace. They went insolvent, and so that was an issue a few years ago. And so that's changed the way a lot of us E&S wholesalers are looking at the MGA markets. You know, at Ryan Specialty, we actually get a copy of the reinsurance with all of our MGA products that we're working with, to make sure that we know who their reinsurance is coming from and where that capital is coming from. That's just one extra step that we now have to take that we weren't necessarily taking, 5 years ago. We're also looking at some of our legacy carriers. They're having loss reserves and allocations, readjustments. And so that's causing them to either exit the marketplace or reduce their footprint in the marketplace, which brings in more of these MGA type markets can come in and fill that, or your traditional marketplace has to come in and fill that. But that does create that supply and demand, and potentially pricing can go up when that supply and demand is not necessarily being met. And I will pause there for any questions, Greg.
Yeah, Pam, I think just be mindful of time. Want to make sure that Mark and Danny get plenty of time to talk about reinsurance. But I do have one very quick question that I think you'll be able to roll the answer right off your tongue here. And it's, what attributes do you look for in an E&S carrier that you think are really important to be successful with a wholesale distributor?
With the carrier?
Or the individual underwriter, right? How does an underwriter become successful with a wholesale broker?
Right. It's all about relationships, and you have to have a good relationship with your market. And that flows through the entire, organization, starts at the top, goes all the way down to the person answering the phone. And when it comes to the underwriter itself, we're looking for somebody that we can communicate with, somebody that picks up the phone, somebody that knows what they're talking about. So somebody who is educated. The underwriters also have to be as specialized as the product, that we're specializing in. So we align best with people that do understand their product, and recognize the positions that we're in, and meet deadlines, and can also help us potentially understand the product better too, as we're all learning some of these together, such as wildfire. So always like an underwriter who can help educate, our team and us as well along the way.
So speed and specialization over generalist, I think is what I heard there. So thanks, Pam. I think it's a good time to turn over to Danny and Mark to get the perspective from the reinsurers. So obviously the floor is yours, guys, but I am curious to know, what the reinsurance community thinks about E&S right now. Are they excited about the growth that the E&S segment is driving, or are they a bit skittish and cautious about the cat exposure?
So I'll jump in first, and I think what we'll try and do here for everyone's sake, I will try and focus more on the property market, and Mark will try and focus a bit more on the casualty market. But we both work in both spaces, so happy to kind of cover them together. But in general, reinsurers prefer the E&S space, and right now, some related topics that we can kind of jump on from what David and Pam have both touched on is, there are a lot of MGAs trying to come into this space. There is a big shift from the admitted market to the E&S market. I'd say we are seeing the major carriers pull out. It's a very easy thing to speak on is California homeowners. That has been an emerging topic for us, our team in particular here in San Francisco, and trying to find capacity for those insureds. So whether it's traditional reinsurance or reinsurance behind fronting capacity with MGAs, I would say reinsurers certainly do get excited, to answer your question, Greg, about E&S versus admitted. The flexibility in pricing is key, tighter terms and conditions, exclusions, they're all things that reinsurers get excited about. Now, on the opposite side of that, reinsurers have taken some significant hits, whether that's in California specifically or just globally with different events going on. And those global events, whether it's California specific or Florida hurricane or the SCS activity that's kind of gone through the Midwest very significantly over the past few years, that does have an impact, regardless of where you get hit, it impacts the capital available for the market, which ultimately is going to impact pricing. So I would say, there is a significant amount of capital coming into the marketplace. Some is traditional reinsurance capital. We're seeing an increase in, call it the alternative capital from ILS-backed markets, captive markets. So that does have a positive impact on the insurance, but with significant cat events over the past few years, and to go back into California specifically, the wildfires, that does drive a much higher cost. So with very little supply and very high reinsurance pricing, now as a new California resident, I've seen that is not having the same impact that I would have liked to see as an insured. But I will say, putting these programs together and putting, a couple new California homeowners programs together in recent times, you're able to increase wildfire deductibles to a very significant place. You're able to exclude things that otherwise, wouldn't have been excluded for many, many years. You're able to, kind of put sublimits on different things. And so it's having a tough impact on, what the insureds can buy or what the carriers can offer. But from a reinsurance perspective, it's giving them comfort and allowing them to at least put capital behind it versus just completely pulling out like some of the admitted markets have done on the insurance side. That being said, the past couple of years in particular, while they have hit a lot of news from what the events have looked like, reinsurers in general are still seeing very positive returns over the past few years. Retro pricing is in a good place, which allows reinsurers to free up capital and be able to put that capital behind specific target areas. Some reinsurers do like the diversification outside of catastrophe risk. Some in particular, especially over the past few months when there's a bit more clarity around what these recent California wildfires have been, are trying to specifically take advantage of a hard market. They have the opportunity to get much higher returns. It's volatile capacity, but it allows them to charge higher rates and price to much higher margins with the hope that over time, those margins will have very significant impacts on the company. So there are a lot of things I could talk about with reinsurance, MGAs that we work a lot with and how that impacts the market. But to not go too deep into things and to save some time for Mark on the casualty side, happy to pass it there unless there's any specific property questions you guys would like to jump into, Greg.
I guess one quick question, just most of the press releases around pricing right now, at least on the direct side, are things are relatively soft. So do the reinsurers have concerns about the direct underlying pricing right now, or is that a moot point because of some of the returns that they've delivered?
So we are seeing, especially coming up to 1/1, which is always a big renewal for the reinsurance world, that pricing is continuing to go down. There is a lot of capital, which is helping that pricing, but reinsurers have capital that they're willing to deploy. And so they're still coming into the market. We want to call it a hard market. You try and look at it on like a very specific geographical, focus. So I will say there are still hard pockets, California being one very hard pocket. But, even with pricing coming down a little bit, as much as reinsurers, some of the recent conversations, them trying to hold pricing, but, we're going to see prices, call it on a US basis, down 5, 10, up to maybe 20% for loss-free accounts. But it's the capital that's coming into the market that's kind of flattening, allowing the pricing to not go too haywire in the hard market space.
Thanks, Danny. All right, Mark, let's turn it over to you to get a perspective on casualty. You've got about 7 or 8 minutes left here. And I also want to remind the audience, if there's any questions, go ahead and put it in the chat, and I'll try to get 1 or 2 at the tail end here. So, Mark? Oh, we can't hear you. It's a bit staticky or try again. No. Danny, can you hear him?
No,
No.
I can see him speaking, but
Yeah.
it's
You could do sign language.
all right.
Well,
So
while
we
he's
lost. But
go ahead,
yeah,
Dan.
good.
If you're going to pick up anything on casualty, otherwise, I was going to open it up to the audience if there's a question or two from the group.
Yeah, I was going to say we can let Mark try and jump back in. I think it's interesting when we talk about casualty space. I would say that's going to be a bit of a softer market, but I'll let Mark try and jump back in. Pam and David, actually, there's a lot of things that are very consistent from the insurance and reinsurance perspective. So some of the items that Mark may have touched were probably already covered a little bit, but can maybe open this up to questions, and if he jumps back in, give him an opportunity to jump in too.
So, Danny, you're finding casualty be softer. I mean, I would have thought the opposite, just in terms of some of the social inflation dynamics, and most of what I'm hearing from our broker partners are our competition continue to shrink capacity, drive rate. Third party litigation funding has been a major issue that carriers are trying to address. So, rates and terms and conditions continue to get a bit more conservative, at least on many of the tougher to place casualty risks. And
Yeah,
Pam, I'm
so
sure. Go
go
ahead.
ahead.
I was going to
I was
get
going to
Pam
jump.
into.
All right, you
You
go.
go. You go.
So I'm just jumping in. There's a few lines in particular we're seeing. So auto certainly, we would say, trying to find commercial auto capacity is probably one of the most difficult things we're finding in the market today. That's been a struggle from trying to find insurance capacity as well as reinsurance capacity. And so my soft comments don't span specifically to one line of business or to the market as a whole. But we are seeing from a general perspective, insurers are trying to drive commissions and get some higher commissions now. So I would say there's an availability of reinsurance that is allowing insurers to try and push on commissions in the casualty space more than they may have in the past.
And Danny, any trend, quota share versus XOL?
I would say, I do more in the quota share space. So it's a bit easier for me to comment there. Now, if we talk property, I can talk quota share per risk cat XOL all day, but on the casualty XOL, it's not something that I can probably comment on. And honestly, probably Pam and David might be able to have even a bit more commentary on that as well.
Yeah, I think I've seen what I see from the filings that come in is, and I think Pam talked about this, is insurers only able to offer lower limits. So where it used to, an insurer would offer a $5 million limit, now it's offering two, and then you have to have another insurer that adds that extra three. And what my understanding is it's driven largely by the reinsurance terms and conditions getting a little stricter, capacity being a little more limited. And I see that from my own personal experience when as I mentioned, the HOA exposure is that we used to have six insurers on the property side that insured our entire HOA community. Now we have over 60. So it's definitely we're seeing that impact. And again, we're just hearing this from restrictions driven by the reinsurance markets.
I guess I'll ask one more question, then we're probably going to be at time. And maybe this is for you, Pam. And I don't know if you've seen any shifts in the collaboration between reinsurers, direct insurers, and brokers in recent years, but any kind of change in how those three stakeholders are collaborating across the industry?
It's much more prevalent today than it has been in the past. I think their roles used to be very distinct. And today, because it does take a village, to get this done, we are working together. And so I have a hatch where I'm working, creating those auto products and working in the quota share market with reinsurers and so forth. But that also has helped in my non program hat and building proprietary product hat. Knowing these same stakeholders in the capital is helping me, drive solutions in other areas that are outside of that. So I think it's more fluid. And I think all of those different stakeholders and divisions are looking for ways to cross into and come up with more creative and innovative. I think the word innovation here just continues in insurance and it's all areas. And this is just another area that the whole alternative risk market is becoming more in the forefront, and people will be hearing about it and recognizing it when they see it on placements where, 5 years ago it wasn't. It was either a captive or it was traditional or it was an RRG. People had those household little names in their head, but today you're putting a captive in with a tower, so we're filling a hole with a captive here, we're doing this over here. It's just all becoming more fluid.
Well, I also think you addressed it a little bit in your session, is the expansion of the MGA space. And as you've got MGAs with fronting companies, you've got a multitude of reinsurers that might sit behind that fronting company. It's just natural that you'd see a lot more collaboration across the different stakeholders. So I think we're right about time, guys. Any closing comments from any of the panelists before we wrap up the session?
I think very quickly, just on that point, MGAs, AI, reinsurers, from our view, they want to partner with those people that are going to be specialists. And this goes off to what Pam was saying. Reinsurers are now having meetings with the fronting carriers, with the MGAs, hearing from the insureds directly. And you're seeing a very positive impact in terms of people that are trying to better understand the risks so that they can provide capacity. People want to find ways to provide it. Hopefully over time that has a positive impact on the insureds, like myself and many others on here that are in the space. And so, I think you're going to see a continued emergence. I think right now we say the reinsurance market is in a pretty good spot, but hopefully over time we can continue to kind of help pass along some positivity down to the insureds as well.
Yeah, Greg, I think Danny, is spot on with that. And one other thing I would add to that is the regulators and the rating agencies are taking notice of that. And so there's increased interest, increased questioning of those relationships, of how those developments are coming about, emerging, and how they're being utilized to provide insurance solutions products to the consumer marketplace.
Thanks, David. I think we're about out of time here, guys. So a special thank you to David, Danny, Pam, and Mark. I know you carved out some time out of your day to be part of All Industry Day today. So appreciate the well thought out panel. And at this point, I think we're going to turn it over to some breakout awards. So again, thank you, everybody. And we'll see you later.
Thank you.
Thank you, guys.